When you look at your portfolio, you have basically been conditioned by, well, pretty much every financial blog and analyst note out there to look for one specific thing above all else.
Oh, absolutely. Top line growth.
Right. Top line growth, more sales, more locations, more employees, just, more gross revenue.
Yeah, it's the default metric.
I mean, the entire architecture of the modern corporate machine is engineered to make that top line number go up. It's practically the first law of thermodynamics in the business world, right?
Sure.
You look at a stock chart or you look at a quarterly earnings report and you just inherently want to see that revenue line moving up and to the right.
And I mean, there's a good reason for that. Historically, growth kind of masks a multitude of corporate sins.
Yeah, exactly.
If the top line is shrinking, the immediate, visceral assumption from the market is that the business is failing.
Totally.
Algorithms are literally programmed to execute sell orders the millisecond a revenue miss hits the wire.
Mm-hmm.
The market just views revenue contraction as this giant, flashing, existential red light.
Which that brings us to the central puzzle we're going to dissect today. Because every once in a while, you step into a scenario where a company is deliberately, intentionally tearing down its own revenue structure.
Yeah, doing it on purpose.
Exactly. You have a management team looking at a stack of paying clients, people actively writing them checks and saying, no thanks, we don't want your money anymore.
It's wild to see.
It is. Suddenly, that deeply ingrained instinct to just look for top-line growth is totally upended. You're looking at a financial landscape that is just incredibly counterintuitive. And if you don't know how to read the mechanics beneath those numbers, you might completely misinterpret what is actually happening.
It's the absolute definition of addition by subtraction.
Right.
And it is a fascinating, really high-wire act for any executive team to pull off. Because you're basically asking your shareholders to endure immediate, tangible pain for the promise of, long-term structural gain.
Like dismantling the airplane while you're still flying it.
Exactly that. You're just hoping you can bolt on a jet engine before you hit the ground.
Well, if you are out there trying to figure out how to evaluate a company in the middle of a massive identity crisis like that, you are in the exact right place. Today, we have a highly specific, investor-focused mission.
Let's get into it.
We are taking our standard talk ticker style approach to completely breaking down the Q1 2026 earnings call of Mastech Digital.
MHH for those tracking.
Right, ticker symbol MHH. We are going to cut straight through the Wall Street jargon, hit you with the hard data from this call, and distill what this actually means for your capital.
And just for some context, if Mastech Digital isn't, on your daily watch list, they are historically an IT and digital transformation company.
Right.
They basically provide the technical talent and strategic consulting that larger corporations need to run their digital infrastructure.
But the twist is they are changing.
Yeah, drastically. What makes this specific quarter so critical to study is that they are right in the thick of a fundamental pivot. They're abandoning that legacy identity to rebuild themselves entirely around an AI-first business model.
And man, an earnings call like this one, it is dense.
Oh, incredibly dense.
It's packed with safe harbor statements, layered accounting metrics, and executives, trying to put the best possible spin on complicated numbers. So our job here is to extract the signal from that noise.
Yep.
To respect your time, we're going to structure this deep dive into 4 parts. First, we'll dig into the headline numbers to see what the market reacted to. Then we'll peel back the layers to understand the operational story driving those numbers.
Then look at management's guidance.
Exactly, dissecting the strategy moving forward. And finally, bring it all home to an actionable bottom line for your portfolio. So, okay, let's unpack this. Let's get straight into the raw data from Q1 2026.
It's a bit of a head spinner, honestly.
It really is. The consolidated Q1 revenue came in at $41.1 million. Now, that represents a 15% decrease year over year.
15%?
Yeah, a 15% drop in top-line revenue is not a rounding error, and it's not some slight cyclical dip. That is a massive contraction in the total volume of business they're doing.
Look, if you stopped reading the 10Q right there, you would probably just hit the sell button.
I would.
Right. A 15% drop in a single year for a tech-adjacent company usually signals a massive loss of market share or a fundamentally broken product.
Yeah.
But the true narrative of this quarter is found when you move down the income statement.
Because despite that huge drop in total sales, profitability went in the exact opposite direction.
Which is the crazy part.
Totally crazy. Non-GAAP net income came in at $1.3 million. That translates to 11 cents per diluted share.
Whoa.
And to put the magnitude of that swing into perspective, a year ago, they posted a net loss of 6 cents per share.
They completely flipped the script.
Flipped it entirely. They went from burning money to making 11 cents per share. And even if we look at it on a GAAP basis, net income was positive at 2 cents per share compared to, a pretty significant loss the prior year.
We really need to pause here and unpack the mechanics of those accounting terms, because GAAP versus non-GAAP gets thrown around constantly on Wall Street. And it is the key to understanding Mastech's actual cash generating power right now.
So break that down for us.
Sure. So GAAP stands for Generally Accepted Accounting Principles. It's the standardized, very rigid rule book that every public company must follow.
Right, the official numbers.
Exactly. And it includes absolutely everything. That means non-cash expenses like stock-based compensation or one-time charges like severance pay.
Which is highly relevant here. I mean, if they are shrinking the company, they're almost certainly paying out severance to the people they just let go.
Precisely. The GAAP number, that 2 cents per share, it's bogged down by those restructuring costs. But non-GAAP earnings strip out those one-time messy accounting realities to show you the core operational cash flow of the business.
So it's basically answering the question, if we ignore the one-time cost of tearing down the old business, how profitable is the actual day-to-day operation?
Yes. And the answer is 11 cents per share.
That is a huge difference.
It is. That delta between the GAAP and non-GAAP numbers tells you that the underlying engine of the new business is humming, even if the exterior of the car is, currently in the shop.
I want to highlight the gross margins too, because this is where the math gets really interesting for me. Gross margins managed to increase by 10 basis points.
Which doesn't sound like much.
Right. For anyone who doesn't speak in bond trader terminology, 10 basis points is 0.1%. It sounds totally infinitesimal.
But it's huge in context.
Exactly. Achieving any margin expansion whatsoever while your top-line revenue is falling by 15% is incredibly difficult from an operational standpoint.
Yeah, usually when revenue drops, margins just collapse because you lose your economies of scale.
Right. You still have to pay the rent on the office, you still have the same software subscriptions, but you have way less money coming in to cover them.
So that margin expansion is the undeniable proof point that management's strategy is actually working. It shows they aren't just losing business randomly, they are surgically removing the specific contracts that were dragging down their profitability.
I was trying to visualize this, like how a business makes less money on the top line, but puts more money in its pocket at the end of the day. And the best way I can conceptualize it is to imagine you own a restaurant.
Okay, I like this.
So you run a lunch service and a dinner service. Your dinner service is packed every night. People are ordering expensive steaks, high-end wine, 3-course meals. The margins on those tables are fantastic.
Right, high quality revenue.
Exactly. But your lunch service is a complete disaster.
Yeah.
You have to pay the cooks, the waitstaff, the electricity, and you're just selling a handful of cheap sandwiches to a few stragglers.
So you're basically burning cash on payroll and overhead to keep the doors open for an activity that yields practically zero return.
Right. So you make the difficult, seemingly counterintuitive decision to cancel the lunch service entirely. You lock the front doors until 5 p.m. Now your total sales, your top line revenue is absolutely going to drop. You aren't selling those sandwiches anymore. But your total profit actually goes up, because you are no longer paying a full staff to stand around waiting on empty tables.
You've eliminated the unprofitable drag on your business.
Exactly, allowing the highly profitable dinner service to shine through on the bottom line.
And in Mastech's case, those wait staff are the billable IT consultants. Mm-hmm. We are seeing a classic transition from prioritizing revenue quantity to prioritizing revenue quality.
Right.
When institutional analysts see EPS flip from negative 6 cents to positive 11 cents on lower revenue, they understand immediately that the company is executing that exact restaurant strategy.
They're translating Wall Street jargon like pruning non-strategic positions into actual tangible profit for the shareholders. It's a remarkably brave move by the CEO, Nirav Patel, because he has to stand up on that earnings call, face the analysts who are obsessed with growth, and say, yes, we shrank the company by 15%, and yes, we did it on purpose.
It requires the investor base to be sophisticated enough to look past those superficial headline numbers. The leadership team is essentially asking you to trust that a smaller, more profitable Mastech is inherently more valuable than a larger, unprofitable one.
But to truly evaluate if that trust is warranted, we have to look at the mechanics of what they are actually cutting.
Right, and what they're building in its place.
Which brings us to the second part of our framework, the operational reality, the story behind these numbers. Because in this quarter, Mastech didn't just tweak their strategy, they executed a major structural reorganization.
A huge one.
They took their entire operational footprint and realigned it into two brand new reporting segments, the talent segment and the data and AI segment. Patel explicitly called this out on the call as one of the most consequential decisions they will make this year.
And this kind of segmentation isn't just an accounting trick. It fundamentally changes how the sales teams operate, how they bid for contracts, and how they pitch themselves to enterprise clients.
And the numbers within these two segments tell a dramatic story of two businesses heading in radically different directions. Let's look at the talent segment first.
Legacy business.
Right, this is their legacy IT staffing business. Historically, this meant providing bodies to sit in seats and write code or manage databases. Revenue here was $28.5 million, which is down 11.8%.
They aggressively shed headcount.
They really did. They lost 163 billable consultants compared to a year ago. That brings their total consultant base down to 619.
Which is a massive 20.8% reduction in their workforce.
Over a fifth of the workforce gone. But look at the pricing dynamics of the consultants they retained.
That's the most fascinating part.
It's the craziest part. The average bill rates, meaning the actual dollar amount they charge a client per hour for these consultants, hit an all-time company high of $90.91.
Wow.
That is up from $87.82 a year ago, so they have 20% fewer people, but the people they do have are commanding a significant premium in the market.
Which perfectly aligns with your restaurant analogy. They let the sandwich makers go, but they kept the executive chefs.
Exactly.
The legacy IT staffing model is notoriously a race to the bottom for margins. It basically operates through vendor management systems where a massive corporation says, we need 10 Java developers and 20 different staffing firms submit blind bids.
Right, it just becomes a pure commodity pricing war.
Completely. By shedding those commoditized contracts, Mastech is signaling they no longer want to play in the discount bin. They only want to provide specialized, high-end talent that warrants a $90 an hour bill rate.
But the truly compelling narrative, the entire reason they are enduring this contraction, is found in the second segment, the data and AI segment.
This is where it gets good.
Revenue for this segment was $12.6 million, which is actually down 21.3% year over year.
Which on the surface looks terrible.
It looks awful. But the new bookings for this segment hit a historic high of $7 million in total contract value, or TCV.
7 million.
Yeah. That is nearly a 90% increase in new bookings compared to the exact same quarter last year.
We really have to unpack the difference here between recognized revenue and total contract value, because it's basically the linchpin of the bullish thesis for the stock.
Right. Break that down.
So recognized revenue is a lagging indicator. It tells you what happened in the past. If they signed a contract 2 years ago that is slowly winding down, that shows up as falling recognized revenue today.
Makes sense.
But TCV bookings are a leading indicator. They tell you what's going to happen in the future.
So a 90% spike in new AI bookings means?
It means they just signed a massive influx of new deals that will slowly convert into recognized revenue over the next several quarters.
Ah, I see.
It suggests this tidal wave of high margin cash is building up, even as the current recognized revenue looks weak due to, those old legacy contracts rolling off the books.
And they gave a very specific, tangible example of where these new bookings are coming from. This growth in the AI segment was anchored by a major multi-year deal with a top 10 healthcare payer.
A huge client.
Massive. Mastech is going to build a next-generation AI-ready data platform for them, built entirely on Microsoft infrastructure.
Nice.
The CEO actually noted that this relationship started with basic data management work in the past, and Mastech managed to cross-sell and elevate that relationship into a massive AI transformation deal.
Let's translate what building an AI-ready data platform actually requires technically.
Yeah.
Because it really highlights exactly why Mastech is abandoning the old staffing model.
Yeah, let's get into the weeds a bit.
If a massive healthcare insurance company wants to use a large language model to automatically process claims or analyze patient outcomes, they cannot just plug ChatGPT into their mainframe.
Definitely not.
Legacy healthcare companies have terrible data hygiene. Their data is incredibly siloed. The billing department's data doesn't talk to the pharmacy's data. It's stored in outdated, fractured databases all over the place.
And if you feed that garbage data into an AI,
the AI will hallucinate and produce garbage results.
So Mastech isn't just building the AI itself, they are building the plumbing required for the AI to even function.
Exactly. They are going in and architecting the data lakes. They're migrating the fractured databases into Microsoft Azure, unifying the data schemas, and ensuring it's all secure and compliant with, heavy health regulations.
Which is incredibly hard to do.
It is highly complex strategic architectural work. It's a completely different value proposition than simply providing a client with 5 mid-level developers to maintain a legacy app. By realigning the business to focus on this, they're moving from being just a vendor to being a true strategic partner.
Okay, here's where I want to push back hard.
Let's hear it.
Because I've read the transcript carefully, and I'm not entirely convinced this is all just a brilliant proactive strategy.
Fair enough.
The management team sounds great talking about trading cheap headcount for expensive brainpower. But on the call, the CFO, Kannan Siddhartharman, admitted that the massive reduction in consultants wasn't just from their deliberate pruning of low-margin clients.
Right.
They also experienced, and I'm quoting here, insourcing activity from one of our top 10 clients.
Meaning the client took the work in-house.
Right. A massive client looked at the work Mastech was doing, decided they could do it cheaper or better themselves, fired Mastech, and just hired their own internal people. So my question to you is, playing devil's advocate here, losing a top 10 client to insourcing isn't addition by subtraction. That is a failure to retain a major account.
It is.
How can management spin losing one of their biggest clients as part of a master plan? At what point does bleeding out your talent pool fundamentally break the company's ability to scale?
That is the exact right level of skepticism to apply here. It's a highly dangerous game. And you are right. Losing a top 10 client to insourcing is a brutal hit. Management isn't really spinning it as a win. They're acknowledging it as the harsh reality of the industry they're desperately trying to escape.
Because legacy IT is just too commoditized.
Yes. If a client can hire an internal team to do the exact same database maintenance for 10% less than what Mastech charges them, they will absolutely do it. The switching costs are low.
Right.
That vulnerability to insourcing is the core disease of the legacy staffing model. Mastech was constantly fighting a war of attrition, defending contracts against cheaper competitors, or clients just deciding to do it themselves.
So the insourcing event is actually the catalyst proving why the pivot to AI is necessary to survive.
Precisely. You don't see clients insourcing the architectural design of an enterprise AI migration on Microsoft Azure because the client doesn't have those highly specialized engineers on staff.
It's too complex.
Way too complex. By shrinking the commoditized talent pool, even if some of that shrinkage was forced upon them by a departing client, they are drastically improving their bottom line resilience.
Oh, I see.
Yes, they take a hit to top line scale, but they are eliminating the fragile, low margin contracts that could vanish overnight. They are basically shrinking the base of the pyramid so they can build the peak much higher out of materials that are far harder for competitors to replicate.
And Patel made a point to emphasize the psychological shift in the market. He noted that enterprise clients are no longer asking whether they should invest in AI readiness. They're asking who the right partner is to help them execute it.
Exactly.
Mastech is trying to aggressively position themselves as that premium partner, but executing a transition of that magnitude requires serious capital.
It's not cheap.
No, you can't build elite AI engineering teams with pocket change. Which brings us to the third part of our framework, and arguably the most critical part of the earnings call. How they plan to fund this pivot and what they are telling the market to expect in the coming months. Management guidance.
This is where we need to examine what they said. And right off the bat, the most notable thing about their guidance is what they refused to say.
Yes. The General Counsel opened the call with a very explicit statement that they will not be providing numerical financial guidance.
None at all.
No revenue targets for next quarter, no EPS forecast for the end of the year, nothing. Just a blank slate numerically.
Which is incredibly frustrating if you are an institutional analyst trying to plug neat, predictable numbers into a discounted cash flow model.
They hate that.
Wall Street hates uncertainty more than it hates bad news. But if you look at it from the CEO's perspective, in a volatile macro environment, providing hard financial numbers during a structural pivot is a massive trap.
How so?
If you promise $45 million in revenue and come in at $44 million, the stock gets punished. even if the underlying business is actually healthier.
Right, but they didn't leave the market completely in the dark.
No.
While they refused to give numerical targets, they provided very clear, highly structured operational expectations. First, they threw cold water on the idea of an immediate V-shaped recovery.
Yeah, they were very clear about that.
They warned that the headwinds in the staffing and talent side, the deliberate pruning, and the client insourcing we just debated will persist through the first half of 2026.
So it's not over.
No. So if you hold the stock, brace for impact. The bleeding on the top line isn't over yet.
But the most significant operational update, and really the key to understanding how they're paying for this pivot, revolves around their ADGE initiative.
ADGE. It stands for Efficiencies Driving Growth and Expansion.
So corporate.
It is the most stereotypically corporate acronym imaginable. It sounds like something generated by a massive management consulting firm.
It does, but the financial results of the initiative are very real and highly tangible. The CFO noted that the ADGE program successfully saved the company roughly $2 million in SG&A year over year.
Let's break down SG&A because it gets glossed over in earnings reports, but it is the lifeblood of corporate efficiency.
Very true.
SG&A is selling, general, and administrative expenses. It essentially encompasses all the overhead required to run the business that isn't directly tied to producing the product.
Right, the back office stuff.
It's the HR department, the administrators, the middle management layer, the office leases, the software bloat. Mastech managed to shave $2 million off that overhead in a single quarter.
That's significant.
They achieved this largely by cutting about 53 people from their operational non-billable staff.
And this is where the timeline of the strategy becomes incredibly clear. The ADGE initiative was designed as a two-phase operation.
Okay.
Phase one was the efficiency phase. That meant doing the painful work of cutting the fat, streamlining the back office operations, and securing that $2 million in quarterly savings.
And they finished that.
They have now successfully completed phase one. We are currently entering phase two.
The spending phase.
Exactly, the investment phase. Starting in Q2, they are not taking that $2 million and giving it back to shareholders as a dividend.
Oh, no.
They are planning to take those savings and disproportionately funnel them directly into expanding their AI capabilities.
And they were highly specific about how that capital will be deployed. They are strengthening their go-to-market organization, which means hiring elite sales directors and solutions architects who know how to pitch 8-figure AI contracts to Fortune 500 executives.
You need heavy hitters for that.
You do. They are hiring domain experts in specific industry verticals like healthcare and finance so they can speak the client's specific language.
Yeah.
And most importantly, they're pouring capital into AI engineering and modern data platform capabilities, actively building proprietary tools and software accelerators that they can license to clients.
They even provided a fascinating data point about their hiring trajectory. While their billable consultant headcount, the legacy staffing side, remained flat in April, their overall organizational headcount actually increased slightly in April.
Wait, really?
Yeah. That increase is entirely driven by these strategic AI hires. They've stopped bleeding the old staff and have actively begun onboarding the new brain trust.
What I find so compelling about this strategy is how they are timing this investment cycle relative to the broader macroeconomic environment.
Yeah, the macro is key here.
If you listen to how Nirav Patel described the current state of IT spending, we are witnessing a massive bifurcation in the market.
A split economy in tech procurement.
Exactly. Patel observed that enterprise clients aren't necessarily panicking, we aren't in a 2008-style freeze, but they are absolutely shutting down discretionary or non-strategic IT spending.
Procurement departments have become incredibly strict.
So strict. Decision cycles that used to take 3 weeks now take 3 months. If a project is viewed as a nice-to-have upgrade, it is getting delayed indefinitely or canceled entirely.
Which is why the legacy staffing side of Mastech's business is struggling. Providing extra developers for a nice-to-have app update is discretionary spending.
Right.
But, and this is the crucial distinction that validates Mastech's entire pivot, organizations are continuing to authorize massive strategic investments in data infrastructure and AI readiness.
Because it is no longer viewed as discretionary.
Right. It is viewed as critical path infrastructure. It is non-negotiable.
Wow.
Boardrooms across the country are terrified of being left behind in the AI arms race. If a healthcare company or a bank fails to modernize their data architecture to support AI in the next 36 months, they risk total obsolescence against competitors who do. They view it as an existential requirement.
So Mastech is looking at a macroeconomic chessboard where general IT spending is effectively frozen, but enterprise AI spending is practically mandatory.
Exactly.
And they are taking every single dollar they scrape together by firing their own middle management, and they are shoving it all to the center of the table to capture that mandatory AI spend.
It is an all-in bet on the future of enterprise tech. So if you are looking at the financial statements as an investor, you must fundamentally understand the timeline of this EDGE initiative.
Right.
They have completed the cost-cutting phase. The CFO explicitly warned analysts that if you expect their OPEX, their operating expenses, to remain as artificially low as they were in Q1, you are going to be severely disappointed next quarter.
So the OPEX is going up.
The savings have been captured, the balance sheet looks lean, but those expenses are about to step up significantly as they deploy that capital into the new AI-first workforce.
Which perfectly sets up the final part of our framework, the ultimate question for the listener. We've covered the intentional shrinking of revenue to expand profit margins. We've deeply explored the mechanical pivot from commoditized legacy staffing to high-end Microsoft-backed AI data architecture.
Yeah.
And we've detailed their strategy to redirect their operational savings directly into elite sales and engineering teams. Taking all of this data, the macroeconomic headwinds, and the planned spending into account, what does this actually mean for your capital? Let's bring this home to the actionable bottom line.
Whenever you're evaluating a company attempting a high-wire structural pivot, you cannot look at the income statement first. You just can't.
Where do you start?
You have to start with the foundation, the balance sheet, because the most brilliant strategic pivot in the world is completely useless if the company runs out of cash before they can execute it.
And Mastech's balance sheet is arguably the most fascinating part of this entire earnings report.
It really is.
At the end of Q1 2026, they reported having $33.6 million in cash on hand. Furthermore, they have absolutely zero bank debt outstanding.
None.
None. And they have an additional $21.3 million available to tap on their revolving credit facility if they need emergency liquidity.
I will give a very firm, opinionated stance on this. In the context of a microcap tech company executing a massive turnaround in a high-interest rate environment, this is a fortress balance sheet.
A fortress?
It is an incredibly powerful, insulated position to operate from.
Because debt is the ultimate killer of corporate turnaround.
Precisely. The single biggest risk for any company that intentionally shrinks its revenue is a liquidity crisis. If you have high debt, your lenders require you to maintain certain revenue covenants.
And if you don't hit them?
When your top-line numbers drop by 15%, your lenders panic, your interest rates skyrocket, and you enter a death spiral where you have to cut into the bone of the company just to make your monthly interest payments. You lose control of your own destiny.
But Mastech doesn't have that problem.
They don't. Because they have zero debt and $33 million in the bank, they answer to no one but their shareholders. They can afford to absorb the short-term revenue hit of firing low-margin clients because they aren't sweating a massive debt payment at the end of the month.
That makes total sense.
It provides management with the ultimate luxury in business, the financial runway and the time required to methodically rebuild as an AI consultancy without the threat of bankruptcy hanging over their heads.
But there is one specific detail buried in the financial notes regarding that cash pile that I found super intriguing.
Oh, the buyback.
Yeah. In February 2026, the board of directors authorized a brand new $5 million share repurchase program. They essentially gave management the legal authority to go into the open market and buy back their own stock. But in Q1, they bought back exactly 0 shares, not a single one. That entire $5 million authorization is still sitting there untouched. Why go through the trouble of announcing a buyback if you have no intention of pulling the trigger?
It is a classic, highly effective corporate signaling maneuver. You have to look at the psychology of the market.
Okay, lay it out for me.
By authorizing the buyback, the board is loudly signaling to institutional investors and short sellers, we believe our stock is fundamentally undervalued at this price, and we have the cash reserve to aggressively defend that price if you try to short it further.
So it acts as a deterrent.
It puts a psychological floor under the stock.
But by not actually executing it.
By not executing it, management is maintaining their ultimate flexibility. They are telling the market, we have better, higher yield uses for this cash right now.
Which is?
Namely, funding that phase 2 EDGE investment in AI engineering teams. They want the structural option to buy back shares if the market unfairly punishes the stock, but their absolute priority is funding organic growth.
It's like keeping a loaded fire extinguisher on the wall. You hope you don't have to use it, but you want everyone in the building to know it's there and fully operational.
Exactly. So to synthesize all of these complex dynamics into a clear stance for the retail investor, this is a cautious but fundamentally bullish setup for patient capital.
Right.
If you are a momentum trader looking for explosive top-line growth next quarter, this is absolutely not the stock for you. The turnaround will take time, the legacy staffing revenues will continue to bleed, and the headline numbers might look ugly for another quarter or two.
But for the long term.
But the underlying structural fundamentals, expanding gross margins, all-time high bill rates, a massive 90% spike in AI bookings, and a flawless, debt-free balance sheet, suggest that the foundation for the new AI-centric Mastech is incredibly solid.
Which means we can clearly outline the actionable takeaway for you, the listener. Let's say you currently hold Mastech, MHH, in your portfolio. Your job right now is to cultivate patience and stomach a shrinking top line in the short term. You need to look past the superficial revenue drop and focus intensely on the margin growth. As long as those gross margins hold steady and the EPS remains positive, the restaurant strategy is working.
And if you are on the sidelines,
well, if you are considering buying the stock or initiating a new position, you need to keep a very close, highly critical eye on their Q2 and Q3 SG&A spending.
This is crucial.
The company explicitly told us they're going to increase OpEx to hire these elite AI sales teams and engineers. You want to see mathematical proof that this investment is actually generating returns.
Right.
If their operating expenses go up, but the new AI bookings suddenly plateau, that is a massive red flag indicating their sales pitch isn't resonating. But if OpEx goes up and we see another record-breaking quarter of TCV AI bookings,
then they're doing it right.
That is the definitive signal that the strategy is executing perfectly and their new investments are directly translating into high-margin future revenue.
That is the exact metric to track. It's the ROI on the EDGE savings. Are the expensive new hires actually bringing in the massive strategic architectural deals?
That's the million-dollar question.
The top 10 healthcare payer contract proves they have the capability to do it once. Now they have to prove they have the operational machinery to scale it across multiple industries.
Well, let's pull back for one final thought before we wrap up this deep dive. We have covered a tremendous amount of ground today, dissecting Mastech Digital's Q1 2026 earnings.
We really have.
We have explored the counterintuitive mechanics of how a company can intentionally shrink its total revenue while simultaneously expanding its profit margins, hitting all-time high consultant bill rates, and driving historic levels of new AI bookings.
Yeah.
We've seen a management team actively shedding their low-margin past to build a high-margin future, all backed by the security of a rock-solid, debt-free balance sheet.
It truly is a textbook case study in prioritizing revenue quality over revenue quantity. And it serves as a powerful reminder that as investors, we have to look far beyond the superficial headline numbers to understand the true structural trajectory of the businesses we own.
But, as I was reading through the transcripts and researching the specific mechanics of these AI data platforms, a larger, almost philosophical question kept nagging at me. Something for you to mull over as you track not just Mastech, but the entire IT sector. Think about what Mastech is fundamentally doing. They are taking the cash generated from their legacy IT staffing business, which literally consists of providing thousands of human beings to manually write code, test software, and manage data.
Right.
And they are investing that cash into building advanced AI platforms and automated data pipelines for their clients.
They are funding the AI-first vision with the profits of the manual labor past.
Exactly. But if you follow that logic to its ultimate conclusion, as these legacy IT staffing firms build better, faster, more intelligent AI tools for their enterprise clients, are they essentially building the very automation that will one day make their own human IT staffing segment completely obsolete?
Oh, wow.
Right. If Mastech successfully builds a perfect, automated, AI-ready data platform for that healthcare payer, does that payer ever need to hire a team of 50 human database consultants again?
Probably not.
It feels like the ultimate innovator's dilemma playing out in real time. To survive the current market, they have to physically build the technology that could eventually cannibalize the very foundation of their original business model.
It is a profound existential tension. They are racing to become the architects of the automated future, precisely because they know the market for manual, commoditized IT labor is fundamentally shrinking.
Right.
You know, a brutal game of adapt or die. And they have made the hard choice to adapt, even if it means eventually transforming into an entirely different kind of company than the one they were founded as.
And that nuance is exactly why we do these deep dives. Because a simple 15% revenue drop on a quarterly balance sheet can hide a fascinating, complex story of massive existential corporate transformation. We encourage you to keep tracking those earnings, keep digging into the actual mechanisms behind the press releases, and most importantly, keep questioning the narrative behind the numbers. We hope this has been a valuable shortcut to keeping you well informed and ahead of the curve. Thanks for joining us, and we will catch you on the next deep dive.